morning, everyone. Welcome to our panel on the impact of geoeconomics on investment and deal making. I am delighted to be joined by Nassim Cherchali of Anacap and Phil Edmans of Inflexion, two leaders with deep experience of navigating this global complex environment that we're working in. Gentlemen, over to you with just a brief introduction and your investment focus areas.
Sure. Morning, everyone. Delighted to be here. I'm Philip Edmans. I'm a partner at Inflexion. Inflexion is a mid-market private equity firm investing across sectors across Europe in minority or majority structures.
Hi, everyone. I'm Nassim Cherchali. I'm the managing partner at Anacap. We're a lower mid-market firm, so slightly smaller deals than my colleague at Inflexion. We invest across Western Europe, and we're focused on the financial ecosystem, so services, but also technology and software in the financial world.
Great, thank you both. I think it's safe to say today we're operating in an environment where politics, economics, and strategy are increasingly intertwined, from sanctions to supply chain shifts, regulation to capital flows. And I think for private equity investors, the sort of risks and challenges that are being navigated today are so different from even just a few years ago. So let's get into what some of those kind of forces are doing in the environment that you guys are operating in. Starting with you, Nassim, geoeconomics is shaping capital flows more directly than ever. How does that change the way that you at Anacap are doing that relative to even just 5 years ago?
Yeah, I mean, we're investing in Western Europe and in services, so probably less impacted than others that have manufacturing exposures. But if you had told me 5 years ago that I would need to worry about gas supply in Germany and its impact on German Mittelstand for our insurance broking business in Germany, I would have said you were crazy. But we've had to take these sort of things in considerations, more second and third order consequences for us, but those do exist, and we have to think about it. Maybe on the more positive side, I think we've seen more interest from LPs in Europe, US LPs that had like great run in the US for the last decades and had like 100% of their capital there, maybe taking a few chips off the table, not a lot, but 5 or 10% makes a big difference. And even European LPs have spoken recently to a large sovereign investor in Europe that had 50% of his capital traditionally going to the US and had paused for a few months and they had to invest. So they're looking at Europe, obviously, as their home market a bit more.
Phil, how about you?
Yeah, I mean, I'd echo Nassim's point. I mean, anecdotally, when we're speaking to market participants, Europe is undoubtedly getting a lot more attention from global investors, which is obviously good news for this audience. I mean, as it relates to kind of how it impacts our deployment, undoubtedly geoeconomic or geopolitical events do bring into place sharper focus on things like supply chain fragility and single source supplier, particularly for the manufacturing sectors. But as it relates to how it changes our deployment, it doesn't, I'm boringly going to say. I mean, our deployment philosophy is rooted in having strategic clarity. And for us, that means focusing consistently on high growth businesses with high margins across Western Europe. And what we look to do is identify subsectors within using our large sector teams that have outperformance potential, and we back those teams with capital and our value creation expertise. And we're fortunate we have a flexible mandate that we can, as I mentioned earlier, invest in minority or majority solutions across Europe, and that provides us with an element of optionality. And to Nassim's point around optimism, I mean, I think it's in the mid-market, I think, is particularly where we see agile management teams that are able to adapt to geopolitical, geoeconomic events. And those are the kind of management teams that we want to be backing with our capital and support.
Excellent. I'm gonna keep with you, Phil. Just thinking about sort of sectors and countries now. Where do you see these as being most exposed, and where are the opportunities there?
I mean, it's hard to rule in or rule out whole sectors or countries. What we focus on is business attributes, and I mentioned earlier that margin and growth are key for us. But I think what the geo-economic impacts of supply chain, single source manufacturing do remind us all of is the importance of observing key dependencies. And for us, that is something we always have a high risk flag filter on, and that's related to geoeconomical events, but also customer concentration, supply concentration, regulatory reliance. So we stay clear of those. I mean, we're optimistic about the UK and the European private equity market. I mentioned within the mid-market particularly, there are opportunities to be backing agile businesses with stronger growth potential. They've got the ability to outperform the broader economy. And there, in the mid-market particularly, which is where we collectively focus, that's where you can have a real impact. And the size of the companies that we're investing in also have broader exit optionality. So we're kind of less geared to kind of geoeconomical events.
Nassim, what about you from a financial services standpoint?
Yeah, I think I'd talk a little bit about business leader sentiment. And so we've tried to focus on non-discretionary services. You know that very well at Aon, you need an insurance policy, whether the economy is good or bad. So we've done a lot of insurance broking. We've bought, and I think you have as well, accountancy services. You still need an accountant, and you still need to file those VAT register to fill in the fiscal holes. But when it comes to doing a 10 million software project, maybe you're going to push that back by a year. So we do obviously invest in software and tech in financial services. But in that case, we've been more focused on businesses that sell, smaller projects, smaller point solutions, and not like big transformational projects. So that's been something we've been focused on.
Great. Okay, so thinking about deal structuring now, Phil, how is geoeconomics shaping up in terms of deal terms? So sort of valuations, risk premiums, contractual protections.
Yeah. I mean, geoeconomics and broader macro environment is definitely impacting deals. It's well talked about in terms of deal volumes, and that's the primary reason for that is the bid-ask spread, the value dispersion between buyer and seller, and that is definitely putting a brake on processes happening or completing. That said, there are, as the market evolves, people are finding ways to bridge that valuation gap. You talk about kind of deal structuring, and that could be earn-outs, contractual risk sharing, and other forms of structuring. And so that, in some cases, that has been able to bridge the valuation gap. And again, I think, in bringing it back to the mid-market, in private equity, the market does continue to evolve and innovate. And for us, that's been minority capital, where, again, in the mid-market, where the counterpart of the founder often is looking for a partner rather than necessarily the highest price. They're looking for a supportive partner with capital and expertise to drive their growth. And that flexible mandate and that thirst and ambition from a fellow shareholder has allowed us to unlock opportunities not just with founders but actually corporates, PLCs, as well as other private equity firms as well. So that's great to see that innovation coming through. And also, if you've got a truly high quality business that is insulated from the geopolitical events and has structural tailwinds behind you, I mean, you're getting proper premium value at the moment as scarcity and the demand supply imbalance kind of unfolds.
Great. Nassim, similar views?
I'd say similar things. I think, we've seen earn-outs and deferred payments, having a bit of a resurgence. But to your point, if you have like a great business, then there is still a lot of appetite, still at high valuation and, all cash offers. I'd say we've and probably since COVID already, we've seen some MAC close re-emerging here and there. I don't particularly like them when I sell, but when I buy, I don't mind. But they are still very rare, and maybe in some more regulated sector, you see them a bit more often.
Great.
I mean, I think another point to add, if I may,
Please.
Nigel mentioned it earlier, we have a very, very strong kind of capital markets, particularly in private markets across, in the UK and across Europe, and that's contributing, I think, to the sustained confidence as well, which allows people to, still want to get deals done despite a bit of risk asymmetry and value dispersion.
talking about sort of challenges and uncertainties, what do you see as the biggest ones in private equity as things stand?
Yeah, I mean, we all have the same challenges as any other market in terms of economy, geopolitics. I think the biggest one we have in PE right now is liquidity in the market. Simply put, not enough exit, and so the sort of virtuous cycle of exits fundraising is a bit more difficult. I think you were talking about the debt market. They've been really supportive the last couple of years. I always try to look at for the potential downside. There might be some downside here because there's been a lot of money in private credit, and that's helped keeping a lot of stories afloat. So we talked a little bit about value creation. It's the best immunization against all those problems is focusing on real value creation drivers, buying good businesses, helping management teams grow. I think you can do that more easily in lower and mid market than you can on large caps. But I'm slightly biased.
Phil, what about you?
Yeah, I mean, not much to add. I mean, I think realizations and the lack thereof has been well documented in our industry. But I think that just again calls us to. It's a good kind of checkpoint to remind ourselves. Well, it starts with the investment decision, right? If you back good quality business with a clear investment thesis, i.e., you know what you want to do, and what are you building and for who, you've got a good chance of having exit optionality. Then it goes to portfolio management. You can't just buy and you can't just rely on the debt markets. What you need to do is grow companies, even at times of macro kind of softness. There are opportunities to outperform that market, and we've invested in our value creation capabilities across digital that spans data and AI. We've invested in our talent teams and thought more thoughtfully about organizational structures. And then it does come to actually when you do that exit, well, let's be kind of proactive and thoughtful about it. And we have a dedicated realization committee that's focused on that proactive planning. And then when you do get into it, kind of making sure we have a sharp focus on exit. And that allows us to, that increases our chances of success. And we've exited 7 companies this year.
Fantastic. In terms of just looking ahead and thinking about sort of advice maybe for some of our audience, what would be that one piece of advice that you would give to investors navigating in this fragmented world? Phil?
I don't think this room needs my advice, but what we talk about a lot internally at Inflexion is consistency and having that kind of strategic clarity I mentioned earlier. And that doesn't mean, and that means, I guess, not reacting to kind of the market events which happen and chasing the next market trend or avoiding a news headline, which I know is hard to do in this kind of particularly digital fast age. But that consistency doesn't mean also you can't evolve or stand still. And for us, over our 25 years, our evolution has been exporting our expertise from the UK across Europe. It's broadening our investment solutions for founders and companies, so the minority product I mentioned. And it's also deepening our sector expertise and value creation capabilities. But at the core, over our 25 years, nothing changes for us. We're still focused on high growth, high margin businesses with long-term value creation potential. And that strategic clarity is what gives us the confidence to invest and exit in a volatile macro world.
That's great and encouraging. Nassim?
Yeah, I mean, I'd say, focus on resilient sectors. And focus on backing great management teams and founders. That's been our consistent approach. I think from maybe an LP perspective, try to understand how value was created in the portfolio of your GP over the last 5-10 years. Is it a bit of financial engineering, or is it real value creation engagement with a portfolio company? Because those are more useful than ever in difficult environments.
Do we think that this is a temporary shift, or is this the new normal? Phil?
This being geoeconomics. I mean, it's hard to say that it's hard to say that it's going to kind of necessarily reverse. I think we are in a faster paced environment now, particularly in the digital age, and that's there's no point trying to fight that. If that is the case, just stick to what you're good at and focus on that. That's what we can change.
Yeah, I think that's not going to change. I mean, every morning you wake up, there's something new. So I think we have to, as Phil said, continue focusing on real value creation, sticking to our investment thesis, and carry on, because the world is not going to come more stable in the coming years. Yeah.
Our new normal. So thank you, Nassim and Phil, for just sharing your insights on how geoeconomics is impacting deal making and investment decisions. We've sort of covered some evolving challenges, new opportunities, strategies for adapting to this fragmented world. I hope it leaves everyone with some practical ideas to consider in your own work. And please feel free to continue the conversation with our panelists after the session. And thank you all for joining us.